It's now my honor to present our keynote speaker. Brian Montgomery serves as the Assistant Secretary for Housing, the Federal Housing Commissioner for the U.S. Department of Housing and Urban Development. With over 30 years of experience in both the public and private sector, Brian brings a deep knowledge of housing issues and vast experience spearheading large-scale policy initiatives. He is the only individual to have served as head of FHA twice under 3 different presidents in both parties. Brian developed solutions to assist struggling homeowners during the financial crisis, led vitally important FHA modernization efforts in 2008, and continues to lead in that space today, and spearheaded reform of the Real Estate Settlement Procedures Act, something that no one should have to do even once, and we really appreciate your sacrifice for that one. For any lawyers who have ever dealt with RESPA. Brian is responsible for the management of FHA's $1.3 trillion mortgage insurance portfolio and recently released its annual report to Congress, which detailed continued improvement in the Mutual Mortgage Insurance Fund. He also oversees HUD's project-based Section 8 rental assistance program and the Office of Housing Counseling and HUD's manufactured housing program. After Brian's remarks, we'll take questions National Press Club style, so please write them down on one of the cards at your table and pass them to one of our NHC staff members at any time. And with that, please join me in welcoming Assistant Secretary for Housing and FHA Commissioner, the Honorable Brian Montgomery.
Thank you, David. I appreciate that warm introduction. You read it just like I wrote it. I appreciate it. The last time I was in this room, it was listening to the cast of the TV show Homeland. So hopefully that won't draw any parallels to that for people who watch that show. Well, again, I appreciate the warm welcome, and I'm glad to see that you're convening a group of housing experts. I see a lot of familiar faces in the room, including some people I saw this morning at HUD, Jessica and Conrad and a few others. And I want to say it's a pleasure to be with so many of you in this room who've made housing such a vital part of what you do every day. Well, when I returned to FHA in June of this year, someone referred to me as the Grover Cleveland of FHA, which is the only commissioner to serve in non-consecutive terms. I did know I was coming back, to be brutally honest, but if the comparison holds, apparently my wife did. Allow me to explain. When Benjamin Harrison defeated President Cleveland in 1888, by the way, he won the popular vote, for you historians out there, the First Lady told a member of the White House staff, and I'm quoting, "I want you to take good care of all the furniture and ornaments of the house, for I want to find everything just as it is now when we come back again." And we are coming back exactly 4 years from today. Well, if you've seen the furniture at HUD, it was nothing worth waiting for. But we still have the same table in the conference room and many of the same pictures that you've seen on the wall some 8 years later. Now, Cleveland was known for his commitment to doing what he thought was right, and he was more confident of his ability the second time around. So there might actually be some similarity. Well, in short, I am delighted to be back working with all of you and for all of you to try to set FHA on what I believe is the right course. Well, coming off of Thanksgiving, I'm certain we all reflected a bit on the myriad of blessings we have in this country. And if you were like me, you were grateful, at least for a brief moment, and an opportunity to sit around a table with family and friends and a roof over your head and to give thanks. Ultimately, I do believe FHA serves a critical mission in trying to create economic stability so that everyone can feel part of this country and have a chance to reach their goals for themselves and for their families and to celebrate the same things. I also believe this is a critical time for FHA and potentially for the housing finance system writ large. So it's important that all of you here are engaged. And it's a good time for me, by the way, to hear from all of you. Well, as David mentioned, 2 weeks ago, we released our report to Congress on the state of the FHA Mutual Mortgage Insurance Fund. In fact, next week I'll be reporting to Congress on the same topic, before the House Financial Services Subcommittee on Housing and Insurance. In fact, I had a good chat with the ranking member of that committee, Congressman Cleaver, out of Kansas, or out of Missouri. The results of the financial audit in our report to Congress, I believe, reflect our strong commitment, our desire, and concrete actions taken by FHA to strengthen our future. And it reflects the commitment to our goals for FHA, the guiding principles of our work going forward. Those are three things. Number one, staying true to our core mission, focusing our efforts on those things that promote access to sustainable mortgage finance for qualified first-time, low to moderate income, and minority homebuyers, and seniors who choose to age in place with the help of our reverse mortgage program. Number two, strengthening the foundation of our work, maintaining the integrity of our insurance endorsements, and attracting additional quality lenders to our programs. In doing so, we are assessing the drivers behind the increase in higher risk credit characteristics and making prudent and necessary changes so that FHA financing is available in both the good times and the bad. And number three, appropriately managing risk on behalf of borrowers, lender participants, and most importantly, the U.S. taxpayer. With an insured portfolio of $1.3 trillion, we have undertaken considerable responsibility. Now, ultimately, we must operate all these programs that are sustainable for borrowers, for renters, for taxpayers, and for all of our stakeholders. Well, here are some key numbers from the past fiscal year. And I'm not going to share a lot of statistics because it is lunchtime, but 83% of our purchase mortgage insurance endorsements were for first-time home buyers. Approximately $15 billion in new underwriting went to affordable housing through our multifamily programs. And approximately $4 billion in new underwriting went to healthcare facilities, largely in underserved communities who might not otherwise have access to capital. Well, statistics are statistics, and I only bring them up here so you have some context about the current state of FHA. So let's take a look at that. Well, on September 30th of 2018, the capital ratio for the MMI fund stood at a positive 2.76%. The economic net worth of the fund is just over $34 billion, an increase of $8 billion from last year. The capital ratio has remained above the 2% minimum required by Congress for the fourth consecutive year, while the fund's economic net worth has been in the black for 5 years. Most importantly, this past fiscal year, we insured over 1 million single-family loans, providing access to sustainable mortgage finance through the strength of our guarantee. Now, while we can be pleased with the general direction of the health of the fund, the condition today is sound. We do have to be realistic about the fact that it is still a relatively thin margin. The positive performance of our forward book, with a 3.93% standalone capital ratio and over $46 billion in economic worth, continues to carry us across the threshold. Indeed, our forward book is performing well at the moment, thanks in part to a strong economy and a strong housing market. And not be overlooked, important decisions around the forward and reverse books by Secretary Carson and his team that predated my arrival. Nevertheless, we see trends in the forward book that concern us and we think need to be addressed and require our monitoring and vigilance in order to keep them in check and to avoid excesses. Well, near the top of that list are cash-out refinances. As a percentage of both our overall business and our refinance endorsements are growing astronomically. In fact, cash-outs comprise over 63% of all refinance transactions this past year, up from nearly 39% last year. And this is despite a decrease in our overall refinance volume in 2018. We believe the increase in cash-outs poses a potential future risk for us, but also challenges the core tenets of FHA's taxpayer-backed mission. Similarly, we see an increase in the concentration of mortgages with high debt-to-income ratios. Almost a quarter of our forward purchase business was comprised of mortgages in which a borrower had a DTI above 50%. By the way, that's the highest percentage since 2000. When you couple this with a trend of decreasing credit scores, 670 this year versus 676 last year, which by the way is the lowest average since 2008, most underwriters and housing finance experts believe managing this type of risk layering is extremely important. Lastly, we need to once and for all deal with the challenges of down payment assistance, particularly those administered by self-identified government entities. Aside from gift funds, down payment assistance sources of funds coming from government entities are the largest down payment assistance source within our book and represented over 11% of total endorsement volume. Well, meanwhile, the reverse mortgage program, known as HECM, ended this year with a negative 18.83 capital ratio and a negative net worth of over $13 billion. Well, obviously, we continue to examine the performance of the reverse mortgage portfolio in an effort that it'll hopefully become more self-sufficient and not continually be subsidized by the forward mortgage participants, which we should not forget include first-time homebuyers. But we are committed to maintaining a viable HECM program, which we think is important, especially for seniors who want to age in place. But we cannot continue to see future HECM books being subsidized by borrowers using our forward mortgage programs. We don't think that's beneficial to anyone, much less taxpayers. Well, as you know, we have taken several steps to improve the performance of the 2019 HECM book and future HECM books of business. And preliminary indicators are that these changes will have positive effects. Revisions to the principal limit factor that we implemented in October of last year have shown some progress in improving the financial performance of the 2018 HECM book of business. And we think we will see additional improvements over the 2019 books. Well, as noted in the report to Congress, we did see improvements in the principal limits as a share of the maximum claim amount, known as the MCA, throughout the year. Although the full impact of the changes made last year were not realized until September of this year, when finally all new HECM endorsements were for mortgages originated under the new PLFs. We also expect that the recent revisions to HECM appraisal valuations, which involves we're now doing a pre-endorsement check on all appraised values for HECMs, will reduce the number of inflated home valuations on HECMs that we endorse. This, in turn, we believe will reduce the claim amounts that we pay out unnecessarily for HECM mortgages that are assigned to the Secretary. Well, central to keeping to this mission is managing risk that addresses many large deficiencies that we have, in particular in the area of technology. As I have noted many times since returning to FHA, I believe we have what I call a catastrophic imbalance between the funding currently available to us as compared to the GSEs and the tools necessary to maintain our programs for the future. Well, unfortunately, this imbalance manifests itself in many ways, and particularly through the day-to-day technology and the analytics needed to manage our risk on behalf of taxpayers. As you know, these are capabilities that already exist under the roofs of Fannie Mae and Freddie Mac and many others in the private sector, yet have eluded us at FHA. Yet we manage risk on the back end after the loan is endorsed with a 100% taxpayer backstop. Now today we can only monitor a small number of our overall portfolio to find underwriting defects, and we think that this needs to change. Now, to be clear, we don't intend to build an inflexible proprietary system, and we hope to seek shared services with other agencies, including the USDA and VA, and perhaps even the GSEs. But if shared technology is not feasible, we plan to use modern, off-the-shelf software that is commonly used in the conventional market. We pegged the price at roughly $80 million over 4 years. As many of you know, the President's 2019 budget included a proposal to assess lenders a modest information technology fee, somewhere in the area of about $25 per transaction, which you think will get us roughly to $20 million per year. Again, these are all targeted at single-family programs. Separately, the Senate went a different direction, giving us, well, hopefully giving us $20 million direct appropriation for single-family IT. Well, in addition to the urgency around modernizing our technology, we are evaluating policies that we think will be helpful to good actors who want to continue to participate in our programs. We think our programs should once again work for both depository, and non-depository institutions who want to originate and service loans according to our guidelines. Now, we have taken note over the lender community's concerns regarding undue risks they perceive from a lack of clarity and or perceived unfairness through use of the False Claim Act. The Secretary has told us to work in consultation with the Department of Justice to review and address the use of the False Claim Act. Our office and HUD's Office of General Counsel are now actively involved in discussions with the Justice Department. Our goal is simple. We want to be fair. And to be fair, we believe HUD needs to be a true participant in the process, and we are hoping for that result. Well, part of this process has entailed a review by FHA of our lender certifications and the full implementation of the defect taxonomy through our lender review system, with an aim at preventing bad loans from being made in the first place. Now, we recognize in certain instances, use of the False Claim Act will still be the best tool for protecting the FHA. But we believe there will be no room for bad actors, for example, lenders who do not want to voluntarily meet their indemnity requirements. We're also taking a hard look at our single-family loan servicing requirements with an eye towards streamlining them and aligning them with industry standards where feasible. And we're very aware of disparities in policy that persist between FHA and the conventional GSE market, including foreclosure fee schedules. Now, we remain cognizant of the challenges for servicers, which HUD generally relies upon to carry out such functions, and committed to identifying reforms that we think would help relieve some of the cost burdens associated with foreclosure. And we will continue our dialogue with many stakeholders, including many of you that are here today, on this important topic, and we are open to your suggestions. I'm also happy to hear that today you will be taking a focus during one of your breakout sessions on the topics around affordability. Now, we know that affordability of owning a home has decreased in the past few years, but remains slightly above the historic norm, after years of solid home price appreciation and a solid year of rising mortgage interest rates. Still, for millions of families in many markets around the country, the burden of owning or renting a home has risen and is for many of them overwhelming. Additionally, there's a large cohort of millennials who either still prefer to rent or who are delaying their household formation for various reasons, including perhaps the lasting sting of the last financial crisis, or who simply need their wages to rise so they are able to make the life decisions that look more like previous generations. Meanwhile, budgetary pressures and an aging affordable housing stock must lead our efforts to continue to leverage private financing to address the critical capital needs of existing properties. One way we do this is through the Rad Program. The Rad Program recently hit the milestone conversion of 100,000 public housing units to the Section 8 platform and has generated almost $6 billion in construction investment. Now, I was with Secretary Carson in Austin last month when we actually dedicated or had a groundbreaking for the 100,000th unit. And about 40% of the RAD public housing conversions also involve use of the housing tax credit. So as part of our commitment to further aligning our policies and underwriting to support affordable housing, the Office of Multifamily Housing is working to streamline FHA mortgage insurance applications for projects with equity from the Housing Credit Program. We're also working through a full review of our manufactured housing regulatory framework. As you know, manufactured housing plays a vital role in meeting the country's affordable housing needs, providing almost 10% of the entire affordable housing stock, which, by the way, is particularly important in the rural states, where manufactured homes are approximately 16% of the total occupied housing units. Well, the goal of our review is to develop policies that ensure manufactured housing remains accessible and affordable as a source of housing for millions of American families. Additionally, you've heard about opportunity zones, and provisions enacted in the Tax Cut and Jobs Act are designed to boost investment in communities that we think need it most. If opportunity zones can encourage public-private sector investment in affordable low-income housing and necessary community amenities for the most historically neglected and distressed areas, then that's a huge win for this country. If these zones can help attract new businesses and entrepreneurship, then economic development will be fostered specifically in our nation's forgotten communities. Areas that would otherwise continue to languish within a cycle of underinvestment or neglect. Well, I'm looking forward to working with many of you that I see here today on some vital housing issues, and as we finalize our strategy to modernize the FHA. We need to position it for the future and strengthen it so it's there for our future housing needs as they see fit. And by the way, we know that the government can't do this on its own. The integrity of the system will need to be upheld by private entities making prudent decisions. Nevertheless, we are committed to doing what can be done at FHA to provide a foundation for millions of Americans to achieve their goals and to be a source of stability and strength for the larger market and the larger economy. Thank you again for having me here today. I look forward to answering a few of your questions. Thank you.
Thank you, Brian. I got 11. So we'll start. We have a few questions, and let me start first of all with seemingly obviously one around natural disasters. We've had a lot of them, seem to be increasing. Can you tell us a little bit about what HUD is doing and FHA is doing in the natural disaster space, particularly the California wildfires, and which has not been how we normally think about them, and what can we do on top of what we're doing, because it seems like this is becoming an increasing problem?
Absolutely. Well, the hurricanes last year, Harvey, actually we were in Houston during Hurricane Harvey. We got to see it up close and personal. And Maria and Irma predated my arrival to HUD. But Secretary Carson, and in particular Deputy Secretary Patenaude, have made this one of her top priorities. Deputy Secretary Patenaude's been down to Puerto Rico several times. The Secretary's been down to the Carolinas. He's also been down to Puerto Rico numerous times. Actually was in Panama City, Florida last week, touring some multifamily properties, some senior housing, and a nursing home that had all been heavily damaged. And so far, we've allocated about $35 billion for the disasters. Last year, we're still doing some final assessments for Michael and for Florence. Certainly, the wildfires in California also are of high importance to us. We're still addressing, what we're going to need in that area. In terms of FHA, we've made some adjustments as we see fit. Last year, we announced use of the standalone partial claim, which sort of mirrored what we did for Hurricane Katrina, Rita, and Wilma back in 2005 and 2006. Whereas, we have a waterfall of assistance that we can provide to families, FHA borrowers who need some time to get back on their feet. In the case of Puerto Rico, it presented some interesting challenges to us, in particular that a lot of families there don't tend to move around, and they had developed a fair amount of equity into their homes and weren't interested in a solution that would start them back at 30 years. So working with OMB on the White House, we moved the standalone partial claim up to the first option in Puerto Rico. We didn't do it for Texas and for Florida. We could if we see the need. And so far, we've already seen the change in the number of families who are taking advantage of the standalone partial claim, again, which I think is a unique tool to use in Puerto Rico. In that case, you keep your existing mortgage. Any arrearages up to 12 months are put as a soft second mortgage that you don't have to pay back until you refinance or sell the home, and it's 0% interest. There are some other programs that touch disaster assistance that I want us to take a look at. One of them is a 203H program, which you would think for families whose property is destroyed as a result of a natural disaster. It's the one instance where FHA provides 100% financing. Again, it doesn't have to be a single-family home. If you're in a rental home and you're a presidentially declared disaster area, if it's destroyed, you can take advantage of the 203H program, which most people have never heard of, to get 100% FHA financing. So obviously a lot of the assistance comes out of the Office of Community Planning and Development. But please know at FHA that we're always assessing and adjusting as we see fit, depending on the market and the scope, obviously, of the natural disaster.
Hey, At the end of September, FHA announced that you would be reviewing the FFB multifamily risk sharing program. We're halfway there to the review period, and we appreciate the fact that the program was extended to allow time for this. Can you tell us how that's going, and what can we do to make sure this really effective program stays in place and actually is expanded?
So absolutely, I think the use of the FFB with the traditional FHA HFA risk share program is a mouthful. I think was an elegant solution developed back during the previous administration. The tax-exempt bond market, there wasn't a lot of advantages to the use of that, and someone came up with the idea, I think it might have been Michael Stegman, to access the federal financing bank. So far, we've done about 180 properties using that risk share coupled with the FFB. There have been no claims in that program so far. In fact, there's very few claims in the FHA HFA risk share program anyway. That's been around since 1992. So we are trying to get the program extended beyond the end of the calendar year. As you know, it was supposed to unwind at the end of the fiscal year a couple months ago. We're still having those discussions with folks in the administration. I do know that it's been very successful in 5 states, with the top being Massachusetts. They and New York State and New York City and Maryland and others have excelled at the use of the program. But there are other states, I think, that could be accessing the program. And I understand that there was never any sort of permanence to it. In fact, even when it was developed in the previous administration, there's some deference to the fact this would be a temporary solution if and when the tax-exempt bond market returned, or Ginnie Mae was able to participate in risk sharing. I'm not so sure both of those things have entirely happened yet. I do know Barney Frank had tried to push through the legislation to allow Ginnie Mae to do risk sharing, but was unsuccessful. So I think ultimately getting that fixed would provide more long-term stability for us to use the risk share program without the federal financing bank. But other states who haven't accessed the program or very limited use, I can't encourage or tell you, but I can say if you're interested in its continuance, you might want to voice that opinion to your legislator. And states that I think would present great opportunities for it that haven't used it, I would say probably Pennsylvania, Michigan, Ohio, Texas, would seem to be strangely absent from its use, whereas, again, other states, I think, have excelled at it. So, again, I don't take sides, but I think if we're going to continue the program, it needs to be done with an eye more toward the entire country having access and use of the program.
Great. You have time for a couple more?
Sure. I'm on your dime. So.
All right. Well, that works for
Everyone's
me.
dime.
Can you tell us a little bit about coordination between HUD and HHS to recognize the link between health and housing? And how can we be more effective in that space, especially among government agencies? We talk about pay for success, but it seems like there's a lot of discussion in that space, but not as much action.
Sure, I know there continues to be a lot of discussion. I mean, we have a physician, a neurosurgeon, as our secretary, and I can assure you that he's acutely attuned to this topic, and not just in areas of lead-based pain and others. I mean, we've all seen the statistics behind, just in terms of nation's youth, having the stability of a roof over your head, whether it's through long-term rental housing or even fortunate enough to allow home ownership. I would say that topic's a little out of the purview of the FHA Commissioner, but I can tell you that it is one that the Secretary is keenly interested in.
Okay, and this will be the last question, because while you would stay here all day, your scheduler is having a heart attack. HUD and FHA seem to have lost a lot of talent over the last couple of years in your ranks. What's your plan to attract young, top-notch talent to HUD?
Well, they strangely got me back, but I don't know. So when I was here the last time, yeah, exactly. When I had this job last time, you would see somebody around 35 or under 35, you would say, are you looking for your parent? And I say that with all due respect, because back then, I mean, it was a blessing and a curse. We had a very experienced workforce that, I think even back then, I think the average age was 57. I used to think that was really old, but now it's got to be more than that. Although I will say this, that the previous administration, during the Obama administration, did an exceptional job bringing in presidential management fellows, used to be old presidential management interns, and the folks that they brought into the program are dynamite. I mean, I haven't met one yet that just isn't just emotionally invested, academically invested in the mission and what we do. And if I could get 100 of them, I'd take every one of them. So I think, again, the previous administration did a good job in that. I think we're doing a good job in it. But in terms of absolute numbers, when I walked out of the door in July of '09, after staying for 6 months into the Obama administration, I had 3,109 employees. Today I have about 500 less than that. Now, if you're doing an apples to pineapples comparison, as I call it, back then the FHA fund started to grow after the housing market collapsed, and FHA stepped in and saved the economy from collapse, as Mark Zandi noted before. We'd grown to 450, 500 billion, maybe a little more than that. So today it's 1.3 trillion, but we're minus 500 employees. I know it's a little bit of a difficult comparison, but I can say that I can assure you that the workload has not gone down. So when I got in the door, we had 250 vacancies. We've now cut that number in half, and I think we have another half of that other half sort of in queue. But I can tell you right now, we desperately need several positions. I'm going to put two near the top of the list. One of them just was reposted yesterday, I believe, the Director of Asset Management and Multifamily Housing. That we need someone desperately. Go to usajobs.com and look. I think it's .com and not .gov. The other one is Director of Production in Multifamily Housing. These are two key positions that we actively are recruiting. So if you know anybody interested in that, please have them email me or go to, again, the USA Jobs website. So again, we're always looking for talented folks. As I tell folks, you can serve your country without picking up a gun. And I think government service and housing mission is a great adjunct, a good complement for one another, and encourage people, take 2 years off from your job or whatever you want to do and come work for us at HUD. I can promise you can work 12 hours a day and not get paid very well, but, you know, speaking from experience. You know.
On that note, we don't have a National Press Club mug for you, but we do have we will give you an umbrella on the way out. And thank you very much for coming. Thank you. So I'm now pleased to